Here's Echo.
And that wraps up today's market action. All three of the major averages closing in the green, like Jared was just saying. Dow closing up 436 points. S&P up nearly 2%. The Nasdaq, the outperformer of the three, up just over 2%, snapping that 7-day slide that we saw. Consumer discretionary utilities outperforming on a sector basis. Energy, the only sector closing in the red. Let's talk about this with our markets guest. We want to bring on John McClain. He is Brandywine Global Portfolio Manager, and Anna Han, Wells Fargo Securities Equity Strategist. Anna, let me start with you. Certainly a rally today, at least. Dow closing up just over 400 points. Nasdaq up around 2%, snapping that 7-day slide. What's your big takeaway from some of the buying that we saw today?
I think the big story and driver here, and has been for quite several months, is yields. As you see yields kind of back off, then equities can rise. And that's been the story and main driver. And a lot of the yield march higher has been driven by real yields and also some contagion from Europe. So I think that's been the main story and taking the headlines. But whether that remains the case, we'll see.
All right, so John, Jared just talked about this. The Wall Street Journal gets a little bit of a tip there, 75-point hike coming in a couple of weeks. Vice Chair Brainerd says we're in this for as long as it takes to stop inflation, and yet the markets rally. Huh? What do you see?
Well, I think your last guess is exactly right here. It's yields going lower today, dollar weakness, that leads to equity markets moving higher. But the Fed has come out and said effectively, look, they don't want the stock market to go higher. They don't actually care about your 401k, and we need financial conditions to be tighter. So good news is bad news, certainly for the foreseeable future here. And I think they are laser focused on price stability here. And investors need to understand the cold hard truth, which is that global central banks, since the GFC, have come to the rescue of markets. And now they are a substantial headwind to asset prices.
John, but I'm curious.
Last time when we were...
John, 7 days the Nasdaq was down. And then we get indication that the Fed is going to continue tightening. How does the tech-heavy Nasdaq rally on higher rates?
Well, rates today are lower, right? But in general, we don't look that much into intraday, day-to-day types of movements. We think kind of longer term and how we're positioning our portfolios. And we think, again, risk is skewed to the upside in terms of rates going higher. And so we would be fading any strength. So instead of buying dips, it's selling rips at this point.
And so, Anna, we know that last time when we were told that a 75 basis point hike was essentially coming, markets were fine with it. But when they actually heard the hawkish tone from the Fed, a very different reaction. How do you expect that to be perhaps any different this time, as we're already starting to have the Fed now talking about this 75 basis points, but without some of the perhaps nuance that we're waiting on?
Yeah, and you bring up a great point. What's even more interesting is actually expectations for the next hike is a little shy of 75 basis points. There's still a camp that believes it could be 50. And I think something that's been encouraging that view has been the economic data we've been seeing lately. We are starting to see signs that some portions of inflation are coming off the boil. It helps as well when you're seeing and the energy prices coming down from peak highs. Now, again, that's not part of the core inflation measure, but it is something that impacts consumers' pockets. So when you put this picture together, it's really showing you that the market is worried about what we've seen, that soft landing. When we have strong economic data, when we hear the not so bad story from corporate earnings, it gives us confidence that equities can weather through, even though the Fed wants to continue to hike. And the Fed is not, in my opinion, is not paying so much attention to equity levels and necessarily trying to stop equities from going higher, but really toe the line between slowing inflation, but not bringing the U.S. economy into this deep recession. So finding that soft landing is really what equity investors are looking for signals for.
John, what about the strong U.S. dollar? Clearly a headwind here for a lot of these larger companies in the second half of the year. How much of that risk has already been priced in?
Yeah, a decent amount of that risk is priced in. We do think that strength in the dollar will continue to overshoot a bit here, because if you look across the globe between Europe, China, Japan, and the U.S. The U.S., the Fed, from the central bank perspective, has the ability to inflict more pain on financial markets. And so we think that's going to lead to a bit of an overshoot on the strong dollar. But as Anna was mentioning, you look at ISM, new export trending below 50 here. We're starting to see the pain translating through corporate earnings.
And so, Anna, in terms of some of the international headwinds, obviously the Fed can only do so much, inflation can only come down so much on its own. What are some of the international headwinds that you think might be pressuring as we look ahead to earnings season?
I mean, the number one thing that we're watching is really the energy markets in Europe. The prices there is impacting, of course, domestic energy prices, but more importantly is what happens with inflation in Europe. And when you see the chances of a recession for Europe to go into a deeper recession, that too is going to bleed over to U.S. corporate earnings and U.S. consumer spending. This all is connected. So that's the number one risk factor we're looking internationally, but also sort of international related, but more domestic focus is midterm elections. Some of the hot topics there is going to be what is the U.S.'s approach to China and what is the outlook going to be for the next 2 years if we get a change in a controlling party in either the House or the Senate. Now, this too could put us in a gridlock. These are the kind of policy changes and the catalysts that we're looking at that can impact U.S. economics.
Looking like a likelihood of divided government as the Democrats probably going to hang on to the Senate. John McClain and Anna Hahn, appreciate you both. Thanks so much.